Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 429. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
Long and illustrious list that it is.
It is. It's an extremely long list of competitors that we beat out each and every week as we slave over the process of bringing you incredibly high quality, engaging, and enthralling content on the subject of life insurance, which is by itself an incredibly captivating subject with loads and loads of interest.
Yep. All the details you need, none of the ones you asked for. So there you go.
That's
our new tagline.
That's how we do it. Today, it's all about index universal life insurance.
I was going to say, we've had a whole run of whole life insurance stuff here recently, so switch it up today.
Yeah. We want to.
And speaking of a whole idea, not index universal life insurance specifically, but what we're going to talk about. Speaking of things that no one asked for, we are excelling today.
Hey, there is a group of people, and I'm going to take creative liberties when I say group people who are interested in very, very deep minutia about finance and insurance.
Yes.
And for those people, remember, if there's two, it's people. We speak to them.
We're here for you.
We fill that void.
Yep.
We fill that void. Now, this topic today regarding indexed universal life insurance speaks to a couple of different things that you and I have come to realize are concerns that people have, but they don't always vocalize them.
Right.
I think it's largely because they struggle a little bit on how exactly to articulate it.
Yep.
And it's a noteworthy discussion because it speaks to an extreme strength that indexed universal life insurance has.
Right.
Especially in the context of building retirement assets for income generation.
Yes.
So we know, because we've been around a while, that there's an argument out there regarding indexed universal life insurance with respect to the assumptions that get made about the product when we try to project future values. So unlike whole life insurance, where we have a dividend scale, and for the most part, we don't touch that.
Right.
We can reduce it, but we can't increase it. It is what it is. That's what we have to use for an assumption to drive future value projections.
Right. Exactly.
Indexed universal life insurance gives us a whole lot more flexibility.
Which can be good or bad.
Yep, can be.
Can be used for good or for ill.
There you go. That is true. And there's been a decent amount of arguing within the industry and within other elements of investment vehicles and finance to criticize life insurance, to say, hey, there may be way too much optimism afoot when it comes to the projections that present what you might accomplish if you buy indexed universal life insurance.
Yeah. Because
we think there's a lot of cases where agents, brokers, insurance companies, they are assuming the growth of cash value is going to be far high, is too high. It's far higher than is going to be a reality.
Yep.
And we've agreed in the past with that notion and have had our own approach to subduing the assumptions that go into the growth of cash value in indexed universal life insurance. I would even dare say that we were very early to the game on that practice. So we had a practice of reducing the assumptions that some people criticized us for.
Yeah.
And
it's okay to be wrong though. I mean, not us, but
the
other people.
And there were arguments like, well, the insurance company has already had this approved by state regulators. So why would you need to assume something lower?
Right.
And then reality unfolded and index cap rates came down and real results differed from what they were projected to be from 10 years ago. So there is certainly an amount.
It went from, I'm trying to think of the highest ones we used to see, but I'll just I know we used to see like 14% cap rates. When you and I first started working together. I don't know that we've ever walked together. I mean,
When
from
we first
like a
started
hotel
walking
to a
together.
restaurant or something.
Yeah.
At a meeting. To, I mean, some of those that were 14 are now 8.
7.
Yeah.
Yeah. Yeah. And the assumed rates were like 8.7, 8.6, something like that. And they're
We
nowhere near that
instinctively
today.
knew that was ridiculous. So
Yeah.
we stayed far away from that.
We did. And there's a whole lot of reason for making reductions.
Yep.
That had a lot more to do with just taking averages, right? Because everybody would argue, well, if you look at the back test and we average out what that comes out to, it's a number like 8.5%. So why not assume 8.5%? And our issue is always because there's going to be influence over what that effectively is over time.
Yes.
And also, we need a contingency for the fact that the cap rate could go down. And if that happens, we don't want to be in a position where now we have to rewrite all expectations because now the cap rate's not 14%, 12%, 11%, whatever it is that it started out at.
Right.
If we reduce this, we have room for that to go down and still be right about our projections.
Yes.
So there is a lot that goes into the process of figuring out what the right assumption is. That takes place behind the scenes. And honestly, that's not something that the layperson, the consumer, the buyer of index universal life insurance should really have to spend time trying to meticulously work out.
Right.
I don't think that many people possess the aptitude to realistically figure that out.
Right.
And
there's some things you got to understand about.
Right. That's not a unique thing to.
Yep.
Right. That's not a unique thing to life insurance. That's all sorts of other financial products that are out there. Same thing exists.
Mm-hmm.
That's why people.
I was going to bring it down to something more basic. Like,
yeah.
When I need my refrigerator repaired, I call the guy who repairs refrigerators because.
Yep.
My knowledge of refrigerators is plug it in the wall and it gets cold.
You don't sit there in the kitchen going, so what coolant we using today?
No.
Because
no idea how any of that works.
I was checking out the subreddits on refrigerant, and that one, I don't know if I like that one.
Yeah. Exactly.
Yeah. There's just a knowledge base that you don't possess, and you're not going to pick it up in a week.
No.
Or 2. So that's why we do what we do. And that's the value that we bring to the table in a lot of this.
There you go.
That? So the other side of this, though, is for the person who buys index universal life insurance and starts to see things unfold. You know, there's 3 scenarios that can unfold right after purchase.
Mm-hmm.
It can basically hit what we thought the projection was going to be. Okay, fine. It can go well above that. Those are great situations. Or because of the variability, it can fall below that.
Yep.
Like the piece that doesn't really come into focus for a number of people until after they purchase is that they look at the ledger from the illustration and they see this static growing amount because we're assuming a static interest rate applicable to cash value every single year.
Right.
That's not how it's going to work.
No.
In reality.
I was going to say that's the one option that's absolutely not going to happen is the one that is depicted in the ledger.
Mm-hmm. And funny enough, there was a time when we could actually go and take like real market results and lay that over the product and show you what the cash accumulation would be. And for whatever reason, regulators decided that we can't do that.
Right.
So the thing that made it look more real, that can't be happening in illustrations. Sorry.
We can't have that.
So we have what we have.
We have to make you assume a static rate that's never going to material. I mean, look, our hope is that we're close.
Mm-hmm.
That's the genuine effort that goes on behind the scenes for us.
Years ago, we used that old ability to lay over real market results to show that those static assumptions at like 8.5%, almost 9% were woefully overstating what was likely going to happen.
Right. Yep.
So you're right. We try to get as close to what we think is reality. In truth, we try to probably bring it a little below what we think is going to happen realistically, because we want some contingency there.
Yeah.
We want to build expectations slightly lower and then be happy when they exceed what we're looking for.
Big if, right? But yes.
Yes. So the analysis that we wanted to do for today's show, especially in the context of these three things that can happen after you purchase a policy, is look at what the long-term impact on an indexed universal life insurance policy is under all three of those situations.
Right.
Because fundamentally, we believe that the variability is always going to exist, but it's never going to be destructive. Which is to say that when we have a bad start to an indexed universal life insurance purchase, we're not necessarily at that point just saying, well, oops, we give up. We should just cancel this.
Right.
Because we fundamentally believe that bad years are going to happen. They may happen in the beginning. And now what we want to talk about today is what happens in extremely overstated situations of these three possible scenarios. So we're going to look at three situations. We get the base case, which is our original static assumption of a fixed interest rate every single year.
Right.
For the particular product that we used for this, it's 6% each and every single year. There's no bonus applied to this index product. So we're not adding any additional adjustments to the growth in cash value. It's just a straight 6% interest on cash value. And then, of course, expenses of the policy being deducted. For really fine details of this, we got to start. We got to set the foundation somewhere. The case that we built, male age 45, putting $50,000 a year into the policy for 20 years, and then taking income from age, like 66 until age 100.
Yes.
So the amount of money going in really does not matter. These things scale up and down. So $50,000 here, the numbers that they're going to correspond to that. If you did 25, it works just the same. If you did 75, it works just the same. If you did 5,000, it works just the same.
Right.
None of that matters. So $50,000 a year, assuming the 6%, based on the cash value that accumulated to age 65, using our general rule of thumb, which is a withdrawal of 6% of cash value when we start the income stream that runs from age 66 to 100 is $98,500 per year.
Right.
Okay. So what we're going to do now is look at some scenarios.
And that's using an index loan?
Yes, it's using an index loan. Thank you for bringing that up. So that means that we're assuming a loan balance that's growing, but that the growth of cash value for the entirety of the policy is not impacted by the fact that a loan is outstanding. So, the exact difference in terms of growth due to regulation, that 6% does get reduced slightly because the loan interest rate is low enough to pull it down. We can't have too much of a gap between the assumed interest rate and the loan rate based on regulations surrounding indexed universal life insurance.
Right.
But it is an index loan in this case.
Because that was a
not
silly game
loan.
people used to play as well.
Yes, they would assume a 4% loan rate and an 8% index credit, which is a fantastic spread, which could realistically happen. It can, like the policy can produce that in certain years, but it's not going to happen in perpetuity.
Right, exactly. It'd just be a happy accident when that happens.
So the first scenario is what we'll call the bad beginning scenario. So
bad boy.
Bad boy years, 15 bad boy years, I'll have you know. So remember, our base case assumes 6% all across the board.
Right.
So what we're going to do now is say, well, what happens if we only get 4% years 1 through 15? And then, just to keep the average at 6% for the entirety of the analysis period, let's have the interest earned years 16 through 55 be 6.75%. That'll get us back to a 6% average across the board.
Okay.
So when we do that, what we're trying to overstate, but analyze in the process, is what's going to happen to the people who buy indexed universal life insurance, and they just run into a number of unfortunately not good years in the very beginning.
Just unfortunate timing. Yeah.
Like you buy the policy and it just doesn't hit those numbers that you thought it was going to hit in the beginning. And you start to get worried. Like, is this going to work the way I intended it to work? And then luck turns around and you get more of what you kind of expected from the outset throughout the rest of the policy's existence.
Mm-hmm.
And it turns out under that scenario, we're fine.
Yeah.
We end up with not quite as much accumulated later in life, but that $98,500 income stream is supported for almost the entire original period. We do end up running out of money. We would use the overloan protection rider in this case at age 100.
Mm-hmm.
So we don't quite make it, but effectively we can generate essentially all the same income that we expected to under the base scenario.
Right.
So even
with
if
15 kind of meh years in the beginning, in a row.
Yep. 15 in a row, which is never going to happen. We're trying to overstate the impact of this.
Yeah.
So then to flip it on its head, we want to look at what we'll call the good beginning years and then the bad ending. So now we'll go years 1 through 15, assuming 6.75. And then we'll assume 5.72 years 16 through 55 to, again, average out that 6%. And again, we end up with the ability to generate that $98,500. We get all the way through this time, and we actually have a little bit more money left over when we get to age 100 than we do under the base case scenario.
Interesting.
Mm-hmm. Interesting because sequence of returns risk has always told us that we would actually want the higher return years to be later.
Right. Yeah, I was going to say that our hypothesis, or your hypothesis in this case, was not that the returns stacked in the beginning and then dropping would have a winning scenario, I guess.
Yeah. Thinking about it a little bit more deeply, though, it's averaging, well, not averaging, it's carrying a higher level of return in those later years, given the boost from the beginning years to get to where it is.
Sure.
But the other thing that this good beginning years, bad ending years also helps replicate is one of the very, 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 very common arguments and very common concerns about index universal life insurance, which is my cap rates could go down.
Right.
And if that happens, that's going to adjust the assumed earnings I get year over year, correct?
Right.
I would argue the way that we do it, not necessarily because we have room for it to go down and we'd still hit the same numbers, but let's take that off the table for a second and just say, all right, let's assume that cap rates go down and now we have to assume something lower. Well, here we see a scenario where our assumption drops by 100 basis points effectively. It's a little bit more higher than that, but 100 basis point drop in assumed year over year earnings for the majority of the analysis period here. And we still end up just fine.
Including the period that you're taking the loans.
Yep. Yeah, right. Where most people feel they're more vulnerable.
Yep. And I believe in this scenario, I can't see my notes, so I apologize. The latter part where it dropped to 5.72. Right?
Yep.
I mean, we're like barely ahead of the loan rate, right?
It would actually pull the loan assumption down similarly to the 6% scenario. The loan interest rate's 5% in both cases, in all cases.
Yeah, right.
So the difference between what the non-loan value would be accumulating at is higher in the base case than would be in the good year beginning, bad year ending part.
Right.
So there's something interesting to be said on the topic of sequence of returns risk in this context. Because I think it's fair to say that one of the risks regarding sequence of returns is not just when the market gives you certain returns, but when insurance companies are forced to make changes to cap rates.
Yes.
Because that's going to impact the overall growth of the policy.
Right.
But even in a scenario where on its face, I think most people would agree, the absolute unfavorable situation is cap rates go down and or market performance stalls out as we go into the later years of the policy.
Mm-hmm.
Because we want the growth. But this analysis shows us, no, not really. Because even though the assumption goes down, starting in year 16 and running through year 55, it has no impact on the viability of generating that $98,500 per year income.
Right. It's a pretty good deal if you can get it.
That speaks to intense resiliency.
Yeah.
Of this style product. And it's one of the key reasons we have been advocates for indexed universal life insurance.
Yeah.
Because it has a very good strength in many changing economic environments. We have put indexed universal life insurance policies in force that have cap rates significantly lower than they were when they were put originally in force.
Mm-hmm.
And all of them that we look at now, I don't have any significant concerns about their growth into the future.
Right.
Now, there is one in particular that stands out that comes from a company that we've had a contentious relationship with for a number of different reasons. And cap rates are, I would say, significantly lower than when the policies were put in force.
Like half.
But even looking at those and knowing the functionality of indexed universal life insurance and some other features of that product, like a bonus that's involved, I don't have substantial pessimism about it.
Right.
And we've been asked by those policyholders, should we cut and run? Like, can you find us a different indexed universal life insurance product to move this money into that's got a higher cap rate? And yes, I can very directly to that question. Yeah, there's other products with higher cap rates, but I don't think you're going to get enough benefit from that to make moving worth it.
Right.
Which is to say, I think this is going to continue to do pretty much what we expected it to do, even with this substantially lower cap rate.
Yep.
Because it's still high enough for us to average out something that's going to be close to the original assumption.
Right. And I should add, we have no incentive for having the people stay or
no, we don't.
Anything else. So
we don't. The one incentive that I always think about is, well, could they go back and reverse engineer this and figure out that I told them this was a great idea, but it turns out they actually ended up with less money? Because they do have their in-force. And they could always compare that to what we end up selling them. And they might look at that and go, wait a minute. If I just kept doing what I was doing, I'd be in a better position.
Right.
And then I'd have to explain that.
Yeah.
So the thing that I think brings up a bunch of criticism toward indexed universal life insurance, which is this variability of earnings, is once you understand it, a considerable strength that the product brings to the table.
Mm-hmm.
And we've talked in the past about how the change in year-over-year index earnings could play a vital role in the amount of dynamic nature of income generation you may have at your disposal in retirement, which is to say, you might start at an income stream of one level and find out 10, 15 years later, you can substantially increase the income that you're generating from it because results have gone so much better than expected.
Right.
And something a lot of people are not thinking about, and it is going to be a problem for them as they advance into retirement, is changing income needs.
Yeah. Well, and one of the things we always point out in these illustrated scenarios is that we assume a static income distribution.
Mm-hmm.
And the reality may be that someone doesn't need $98,000.
Correct.
They say, well, I only need 40.
Mm-hmm.
Okay. Well, don't take 98 then.
Yeah.
Take 40.
Yeah.
I mean, it sounds elementary when I say it that way, but you're going to leave more money in the policy in terms of money that's not accruing loan interest at that point. And that's going to make more cash available over time. So there may be a year that you need more than that. Well, now you have the capacity to do that because you left more money working, I suppose, and not accruing interest on the loan balance. I know this is probably the most confusing podcast that people have ever listened to. This is one of those that it's a lot of words and numbers and words with numbers. And that,
hey, if you listen to an episode of the Insurance Pro Blog podcast and you don't leave slightly confused, we did not do our job.
For 13 years running.
The trick is that you and I are the least confused in the crowd of people, and we don't always succeed at that, by the way, but we try.
That's right. Okay.
There is a robustness to indexed universal life insurance that is what I think is the most exciting thing about it.
Yeah.
Like the insurance industry wants to be innovative. It's hard in some respects, given the products that it has to work with.
Mm-hmm.
And I remember the earlier days of indexed universal life insurance.
Yes.
And the criticism that was levied towards it in regards to the stability and the perceived safety that products like whole life insurance brought to the table.
Yep.
And I understood the logic at the time. I bought into it a lot more at the time. I can tell you, though, that the need for innovation totally exists.
Mm-hmm.
And the things that insurance companies are pioneering in the index space, this is for life insurance and annuities, it is fantastic that we have the ability to offer these things to people these days.
Yes.
100%. The versatility of it and the various things that it can do for people is fantastic. And we have learned over the years that a lot of people do buy into the narrative of maybe cash value life insurance is bad or annuities are bad, but they take that at face value because somebody said that they just arbitrarily placed a lot of authority on.
Yeah.
And once they start to figure out what these things can actually do, they realize that there's a reason this thing exists and has continued to exist because there's value behind it and there's people who buy it and they really like it.
Yeah. Absolutely true.
And I think that's all I have to say about that.
Okay.
So with that,
sounds good.
I am Brandon Roberts.
And I am Brantley Whit.
And we will see you next week.